Now on the screen, you can see the title of this video, Paying Off My Loan Dropped My Credit Score. What the, yep, people are experiencing this thing. People are experiencing whether it be an auto loan, an installment loan. They're trying to do the right thing, right? They're trying to get their budget in play. Maybe they got a tax refund. Maybe they got a bonus at their job. They want to be responsible, so they want to pay off debt. They check their credit score a few weeks later, and they see that their credit score went down. So in this video, what I'm going to do is I want to go behind the scenes and go over what are the reasons that will drop your credit score when you think you're doing the right thing by paying off your debt. And I'm going to give you a couple of tips of how you can pay and when you can pay off your installment loans so they really won't impact you as much as they potentially could. So right here on the screen, I have a reminder, and I always try to get everyone to be reminded of this fact, is who was the FICO score created for? Your three-digit FICO score. When you log into your Experian, when you get a home loan and the lender tells you what your three-digit FICO score is, this whole game, this credit game, was for the lenders. It's for lenders. And for them to be able to figure out very easily who's creditworthy, who's not. Who's going to be more likely to default on a loan, who's not. Who's going to be more likely to be 30, 60 days late, who's not. All of this was for the lenders. I believe in the late 90s, that's when they started to allow consumers to be able to figure out, okay, here's my credit report, here's my three-digit credit score or scores, depending on the bureau. All right, now I'm more informed. Now I can be more in the loop. So initially, this wasn't even for us. This was just for the lender. So we got to be cognizant of that. Remember, when you go to annualcreditreport.com and you download or you get mailed to you your full credit profile, it's a lot of pages. It's a lot of details. When you go to Credit Karma or you go to Experian, you're getting like an abbreviated version of your credit reports. When you get your entire credit profile, when you get that printed out, it's a lot of data. So what Fair Isaac did was they created their algorithm, they created their formula to be able to take all that information, all those pages that you would get from annualcreditreport.com, and then they simplified it into a three-digit FICO score. So depending on the specific lender and the niche that they're in, FICO went ahead and created this system for them. Again, this is for the lender to make easier decisions. Number two, FICO made it easier for the lenders to predict. So again, how likely is it for a borrower to be late, or how likely is it for a borrower to default on the loan? With FICO and their algorithms, they made it very simple, and they are very accurate. Number three, scored between 300 and 850. You already know that, and it's widely adopted. So 90% of the industry uses FICO. The other 10% probably use Vantage or some variation of Vantage. So the reason why I'm taking a second to just go over this particular section is, remember, this is specifically for the lender. So when we're thinking in our head, okay, I'm going to take this money and pay off my loans, I'm going to do the responsible thing. That may be good for you as the consumer, but the FICO, the three-digit FICO scores, Fair Isaac, the algorithms, they're looking for particular things that make them feel more comfortable lending money. So what happens when you pay off your loan? So one thing I want you to be mindful of is 10% of your credit score, and you've seen this image on the right probably in half of my videos. 10% of your credit score is going to be credit mix. Credit mix, what does that mean? How thin or thick is the credit profile? Do you just have one secured card that you got in college and you never applied for anything else? Lenders like to see revolving credit cards. They like to see age. They like to see installments. They like to see mortgages, and I'm going to touch on that in a second. Lenders like to see that you're able to maturely and responsibly take care of different types of debt and pay those different types of debt on time. It makes you look more savvy, it makes you look more responsible, and the algorithm, that FICO score, is going to give you more points the more and the longer that you're able to do that. So let's say you're somebody that you're renting right now. The only loan that you have is you went out and you went to CarMax and you got a $20,000 car loan. You pay that car loan off. Now at this point, again, you're out of debt, which is good for you, but you've now impacted your credit mix. If you don't have other installment loans to fatten out your credit profile is going to start to look thin because they want to see active installment loans on your account. And the key word here is active. Paid off loans will still build a solid credit profile. It just won't disappear. So again, you have that CarMax loan for $20,000. When you pay it off, and let's say you weren't late, you just paid it off, that trade line, that account is not going to just poof disappear and no one's ever going to know that you had an installment loan. That's not how it works. It's just going to be showed as a paid installment loan. That's still going to be good in the grand scheme of things because a lender is going to be able to look at your report and see, okay, you've had this loan for 4 years, you weren't late, you paid on time, you paid it off. Okay, that's cool, but you're not going to get all those points from the algorithm. So number three, something that I don't think a lot of people are aware of, having a mortgage. This is an example of what I mean by lenders like seeing active installment loans. There are lenders, and I spoke to a few last week regarding business funding, and you would be surprised how many lenders that do business funding, how many of them will give out more money to someone if they had a mortgage as opposed to them only renting. I'm going to say that again. You have two identical people, same age, same industry that they work in, they're making similar salaries, they got the same amount of credit cards, everything is similar. One person has a mortgage, the other person doesn't. The person that has a mortgage, they're going to be able to get better loans. They're going to be able to qualify for better loans than the person that is renting. And I've heard this over and over and over again. I spoke with this lender, and they basically said that in their system, in the computer system, when they're punching in all the numbers, because in their algorithm, remember, everything is computer based, because in their algorithm, somebody with a mortgage tends to be more responsible with payments. They tend to default at a lesser rate than someone who doesn't have a mortgage. This is just one example that I can show you that this entire credit game, this entire thing that we're learning right now is all boiled down to, is this thing that you're doing, is it going to be beneficial in the eyes of the lender or is it not? It's very black and white. And having multiple installment loans on your credit profile is actually going to help you more than someone who doesn't, at least when it comes to your FICO score. Now, what can we do about this information, right? One thing you can do is just be strategic with the timings of your payoff. And then I put, this is why lenders say don't do anything crazy during the loan process. So if you've ever been in the home buying process, at some point your lender, your loan officer should have told you, don't do anything crazy from the time you filled out your initial application to the time that you close on your home. Don't do anything weird that could mess up your credit reports. Normally, people say things like, don't go out and buy a car a week before you close on your home, or don't apply for credit cards. One thing you also may want to be aware of is don't do something drastic as pay down, let's say, a $15,000 installment loan a week or two before you close, because you don't know how that's going to impact your credit profile. And depending on how you're trying to apply for any sort of loan, so you may be trying to get an FHA loan, a conventional loan. Every lender has their own like buckets that they'll put you in. So if you have a 740 score, and your income is this and your debt to income is this, they may be able to qualify you for this special type of loan. And if your credit score is this and you have a DTI of this, they'll put you over here. So you never want to do anything that could necessarily rock the boat in the middle of a large purchase. Just try to just be as consistent as possible. Once they give you the keys, once you hit escrow, then you can go ahead and pay off whatever you're trying to do. Then you can go ahead and apply for the new car that you want, because at that point, it's not going to impact whether you can purchase this or not. Only pay things off specifically when the lender is telling you that you need to do that in order to qualify for a loan. The lender may come back and say that, hey, you need to pay this, or you need to pay this down, you need to pay this this credit card to a balance of this. The lender may give you specific homework items in order to qualify. That's completely different than you by yourself on your own accord going ahead and paying things off completely or adding things onto your credit profile just because you think is a good idea, right? So just be strategic. Be strategic with the timing. The second thing you might want to think about is, let's say you got that tax refund, let's say you got that bonus at your job. Instead of going ahead and paying off that installment loan, you may want to, if you have it, you may want to just pay down your credit card utilization. Because if you remember from 2 slides ago when I showed you that pie chart, so the biggest thing that I've seen that has skyrocketed somebody's credit score was taking their balance from 80, 90% utilization, bringing that thing under 30%, 20%, ideally under 10, and then they've seen a 50, 60, 70% increase just like that. So if you have different types of debt, I highly recommend that you take those funds that you have and put those towards your revolving credit card balances. You're going to get more bang for your buck when it comes to, again, your 3-digit FICO score. Number 3, you may want to look into a secured pledge loan. This is a trick that you've seen me talk about a lot on this channel. There's something called a pledge loan where basically with your own money, you can go to a credit union. Navy Federal has that. Signature Fed has that. I did 2 videos on that on this channel. You can check those out, where you're basically putting up your own money. The lender is going to give you a loan based off of your own money, and then you're going to pay yourself back with your own money. If that sounds weird, again, just check out those videos. But it's a very cost-effective way. It's an easy way to add another positive trade line, add another installment loan to, again, thicken that credit profile. If you have a thin profile, this is a way that you can make your credit profile look a little bit more robust using your own money, and you'll just have to pay like a negligible interest rate. This is something that you may want to do, because if you can add 1 or 2 of these type of installment loans to a thin credit profile, you're going to see a credit increase. So in conclusion, it's not fair, but these are the rules of the game. Again, I made sure to start this video off with who the FICO 3-digit score was created for. If it sounds contrived, like we have to jump through hoops to get a good credit score, I understand. So if our goal is to try to optimize our 3-digit credit score to make sure our credit profile is as strong as possible, there's going to be a few counterintuitive things that we're going to have to do in order to make sure that we're optimizing our credit scores. Another thing to keep in mind is your scores will bounce back in time. You may see a hit short term, but if you're doing the things that we talk about on this channel or on my course, or if you're a client of mine, I actually walk you through and give you a tailor-made blueprint of what you should be doing over the course of the next 3, 6, 12 months. If you do everything the right way, you're going to see your scores bounce back over time. It's not going to be something that you can't rebound from. And then lastly, it might be better to have peace of mind and take that temporary credit hit. So again, let's say you got your tax refund, you got a few dollars that you really just want to put towards debt. Let's say your number one goal right now this year is just to get out of debt. You don't want any debt. You might be one of those people that may just say, you know what, screw my FICO score and I'll take the 20, 30, whatever point hit that I'm going to get. My peace of mind, my goal right now is just to be debt free. I'll worry about my credit score later. And that is perfectly okay to take that perspective. If you're somebody that is not trying to, let's say, buy a car or buy a home in the next couple of months, let's say you are already in your home, you already have a car loan, you're kind of stable right now, do whatever fits you and your lifestyle and where you are in life. You do not have to subscribe to any arbitrary rules or do anything that goes against what you feel personally is going to work best for you. All this information is for you to be more aware of the process. I want you to be not in the dark when it comes to what's going on with my credit. So once you have all this information, once this isn't a shock for you, next time when you're trying to apply for something, or when you pay off something, or when you reduce your balance or you increase your balance, I want you to be more in control of your credit score, of your credit report. Once we're more aware of how this credit game works, we're then able to make more well-informed decisions on when we can apply for a car loan or a home mortgage, or when's the best time to pay off our loans, or how we should reduce our credit card utilization. The more information that you have, the better decisions that you're going to make when it comes to your future lending decisions. So that's pretty much it. Hopefully you got a couple of gems from this. If you did, at this point, you should already know what to do. Go down in the comments, let me know your thoughts. If you're not subscribed to this channel, make sure that you do so. Hit the bell notification. We create content like this on a weekly basis, so make sure that you are plugged in. And aside from that, I'm going to check you out in the next video. Have a blessed one. Peace.